Greetings, Biola Capstone course. This is going to be the recording for our week 2, module 2 lesson on tax planning. Per our discussion early, or I should say late in our talk last week, I will be traveling on Monday of this, the start of week 2. And so we will not be doing a live recording on the evening of Monday. I believe that would be the 8th. And so I want to go ahead and record a little class lecture for you. My goal would be to kind of touch on some of the highlights in tax planning. And then what I'll do is I'll then grade our material next week, probably toward the end of the week. And then I'm going to put out another short recording just to give you a little more feedback on the information that we be, information that we be covering, probably the things that you're doing right now, the initial documents, and then the cash flow planning from the case that you've been working on. So that being said, we're going to go ahead and dive into our lesson today. Tax planning is where we're going to begin. And in financial planning, tax planning is usually not the most fun conversation to have, right? Like most people don't really want to talk too much about tax efficiency, even though it is an important aspect of what we do. That client-facing conversation sometimes can hit a wall because they think, well, they already have a tax preparer that has taken care of things for them, and what more can really be done. Furthermore, everyone hates taxes. And so it could seem that maybe the goal would be just to limit how much that you're paying to the taxman on a year-by-year basis. But with what we want to accomplish as planners, oftentimes the longer time horizon, holistic, comprehensive plan tells us that maybe sometimes we should look at a different approach for tax planning. And so today I'll be highlighting what that means. And I will say that tax planning is one of those things that is always on, should be on in the back of your mind as you discuss decisions that need to be made with clients, because there are a lot of numbers. You have to kind of know those numbers and how they're changing on a year-by-year basis. And there are a lot of times when you'll hear something and it all sounds good, except the tax planning little buzzer goes off in your head and goes, oh, that's going to be a tax inefficient way of doing things, or that's going to bite you down the road, or things like that. So all that being said, I thought we'd go ahead and talk a little bit about beginning with the end in mind. And so I'm going to go ahead and share my screen. I've got my big computer screen here, so I'm gonna have a lot of different things up, but I'll try to just do one at a time. Let's start with our course material, okay? We have, for this upcoming week, we will have the Andy case, which is one of those out of the textbook. And then we have the start of more of the CKA, Certified Kingdom Advisor modules. And so this one's going to be on leadership. And then we have the larger DOS case that we're building under the tax planning category. And so just beginning with the Andy case, a few things that we kind of, start with the end in mind. Things that, are to kind of things to know in the back of your mind. As you go through this case, it's actually rather simple scenario. It's not like they have a lot of different Schedule C earnings or this or that. It doesn't mention a capital loss that they have, I think, in a stock, but you know, some of the things that are like absolutes that we should always know, life insurance proceeds, are they taxable? When does it make sense to take the standard deduction versus itemizing? You know, that whole math kind of fits inside of another category within the tax planning. You know, when you start doing the itemization process, it becomes, you know, its own little beast. And so often people are so confused by that, right? Because you go to the normal person and maybe they are maybe they like to give, you know, and you tell them, hey, is that a tax benefit to you? And most of them will say yes. And the truth be told, right, it only is a tax benefit to people who itemize. So unless there's some other type of thing that they have going on behind the scenes, maybe like an owner advised fund. But anyway, all that being said, you know, that's kind of your job. It's going to be your job to try to have those things that are absolutes that you know. You know, a lot of talk in tax planning about doing the math behind figuring out if a tax free type of an investment like a municipal bond makes more sense than others. Okay, and in real simple terms, you can figure that out very easily. You know, you take one minus someone's tax rate, and then you take that divided by the interest that they're getting to kind of see what the tax free equivalent is on it, right? So I will say, just in the world of muni bonds, we had seen a lot of people a few years back before the increase in interest rates in muni bonds, even though it didn't make much sense for them to be in those tax-free categories because there wasn't much, because interest rates were so low, right? Muni bonds had even, I guess, more of a discount than what you would be able to get in taxable options. And so now that we see an increase in tax rates or interest rates, we're seeing it make a little bit more sense maybe to put people in muni bonds. But anyway, all that being said, that's a consideration. It talks a lot about job changes and a decision to move, and how does that affect the tax situation. So as you read through the chapter, as you listen to this presentation, as you see the lecture, right, note those different things, because that's going to help you on that that quiz. And then really ultimately, there's a lot of decisions between saving now and saving later that in financial planning we have to figure out. Does it make sense more to take an income tax break now, or maybe potentially put something into an investment that can grow tax-free? Okay, and of course the Roths are big examples of that, but then we have other ones like whole life policies and things, strategies that can potentially help someone grow you know, their funds in a tax-free way, even though currently it's not going to help you this year, it'll help you down the road. And I've actually got a perfect example of that. I'm going to show you our planning software that we use here called Right Capital. It's a pretty popular planning software. And in that, in this software, you're going to see just kind of an example of that, okay? Because it's going to show, this is just a client. I've changed their name, obviously, but this is a client of ours that just recently met with us, and they brought us this information, okay? So this is kind of the snapshot view of the software tool. It's a simple tool, but what we do typically is go in and make these adjustments and changes. So this family has 3 kids. They're 40 and 39 years of age. He's changing jobs. And so often in financial planning, and even tax planning, right, it's change, a change in income, maybe a new inheritance that comes someone's way, a movement to self-employment, which is really common, right? We see a lot more people nowadays who don't have typical W-2 wages, but maybe 1099 NECs. All of a sudden, they've got a lot more calculus that needs to be made in terms of income, because they're paying self-employment tax. And so that kind of changes the decision schemes in terms of what can I do to lower my tax obligation. But anyway, retirement would be another one. Okay, so this person came in because they got a new job. So we put in how much we think they're living on. We actually did some backwards planning on that, budget planning. I talked a little bit about that in our last lesson. This is their savings. He saved and has been saving a lot into his 401k for years. He's been saving about 20% on his own. He got a little bit of a match. This was through a cell phone company that he was working for. He only currently, like a few months before, had started putting money into the Roth side of his 401k. And the Roth 401k option really was not available in a lot of places up until this last year, with Secure Act 2.0 being signed. So anyway, all that being said, we added this information in. Okay, his income, his wife's a teacher, I think she works as the head of a special ed program at a school. We put in some estimates of their expenses and then their net worth. But under the net worth category, you're going to see that the majority of what they have is tied in his 401k. Okay. So all that being said, we go into the retirement software tool. We can start looking at some things here. But the first one is really tax allocation. Okay. And so there's the three big categories that we talk a lot with clients: taxable money, tax deferred money, and tax-free money. Okay. And so we always like to tell people that we want a good balance between these three. Okay. Because if you are always and constantly taking the tax deferred route, you will pay less in taxes as you march down the road of life toward retirement. But in a way, there is a ticking time bomb there. Books have been written about that ticking time bomb. Okay, I've got one called The Power of Zero by David McKnight. I've got it up here in the office. That one's a little bit of an extreme example. Retirement Ticking Time Bomb is another book written by a guy whose name I think I have a copy of it too, maybe. I'm not seeing it in here, but he writes a lot about the challenge of putting all we have into tax deferred accounts. Okay. Because here's what's going to happen. We'll show you in a second, but they've got very little money in tax-free assets. They've got some money saved in taxable, right? We always say taxable money is money that's come from your paycheck. It's hit your bank account. Now it's your freedom to go ahead and invest it, save it, spend it, do what you need to with it, right? Taxable assets provide great flexibility in retirement planning because it gets you to a point where you can retire a little earlier. Okay, you have more access to those funds. They provide margin in your life before retirement. But then you have the decision, right? Do I go Roth or do I go into maybe a more traditional tax deferred pre-tax option? Well, they've saved most everything they've had into that category. And age 40, they've done exceptionally well, right? Of saving that much money into it. However, the challenge is when you start looking out to our retirement years, okay, this is a Monte Carlo simulation where they are now versus some changes that we've been able to make that are highlighted here in the blue. You're going to see that they've got potential to save a ton of money. This is how much money they would have at the end of the plan in future dollars or in today's dollars. Because they're only 40, right? The plan assumes they're going to live till 90. Potentially have $5 million to give away to their family. But if we go by year, we see that there can be a very significant challenge in tax payment, right? So this is what they're paying on a year basis in taxes, okay? Keeping in mind that they have been putting into that 401k. And matter of fact, we've made adjustment for them to stop putting so much money away into the 401k pre-tax side. But nonetheless, all right, if we go all the way down to RMD age, required minimum distribution age, all of a sudden we're going to see tax payments hit a crazy high number. And that's because that tax deferred money has grown and grown and grown, right? And all of a sudden they have to take out money according to rules by the IRS, starting at age 75 for them, if not pushed back till later. They keep pushing it back later every year, it seems like. But nonetheless, here you see they're paying $150,000 a year in taxes on that retirement account. And so what we want to do, okay, and then we want to help them see that maybe they should start saving more into the Roth side, which we actually are showing them doing, but because they've already saved so much on this side, right, that account's going to grow and grow and grow until it gets to a very, very, very large amount of money. Every year they're going to have to hit the cash register and then settle the score with Uncle Sam, and that's going to be a pretty expensive ordeal. And so there's ways to mitigate that. Of course, the easiest and best way is to save into the Roth sides while you're younger. But then you can also do Roth conversions, okay, when you move money over to the Roth side later in life. And so that's kind of a lot of what we do at our office, is talk about this gap that they have usually if in their 60s between when they've retired and when they hit RMDH. Usually you see a tax rate kind of drop off. And that's all assuming too that tax rates are going to stay where they are. We know that the Trump era tax reform that had started in 2017 will sunset in 2025 if nothing has changed. And so all of these tax rates that you're seeing on your assignments and things will go up about 2 or 3%. But we would make an argument that we're in a low tax rate environment in general, right? And so we can expect to see higher taxes in the future because of all the different things that we have flowing into this, including national debt levels and things like that. All right, so those are the kind of the as we're talking about planning. Okay, I'm gonna put some notes over here on this side. Okay, we have the big three, right? Really, the three different tax categories for growth of money that we have in wealth savings. And so taxable is money that is like bank savings, okay? And tax deferred is money that is in a 401k or traditional IRA. We're holding off on taxes to pay more of it in the future. And I'll say that's kind of what most people think. They think, oh, well, when I get older, okay, I'm going to have less in taxes, less in income. And so I'm going to take that money out whenever I'm in a lower tax bracket. And honestly, that's usually not the way things play out in the grand scheme of things when we start using software like this one, right? To kind of look out into the future on those things. And then the last category is tax free, right? And those would be our Roth accounts. We financial planning, like the Roths are a big deal. It wasn't until 1997 maybe that they were available, but not very commonly used, even up through the early 2000s. And now we're seeing a lot of traction and motivation in using those types of accounts. Those could also be health savings accounts, flexible savings accounts, 529 accounts can be partially tax-free. Because typically you get a break at the state level, not the federal level for putting money in, but then it grows tax-free and you can withdraw it tax free. So anyway, all that being said, we're just gonna go ahead and dive into the lesson today. I've got it pulled up here. I'm gonna kind of like do a little dual screen thing. You can tell I'm a multitasker at work, that's for sure. Always got a lot of stuff up. So all that being said, I think, the lessons and the text do a fairly good job, of course, delineating some different ways that we can look at the steps of figuring out where we're at in our tax situation. Fortunately, it's a lot of like, here are the 10 steps for this and the 5 steps for that and the 3 steps for this thing. So it can be a little much in that regard, but it begins just from the beginning, right? Because honestly, when it comes to taxes, we do follow this step process that is dictated to us by the tax code, that we're going to look at the gross income and then look at your non-taxable income and then ultimately getting down to your adjusted gross income. Okay. And then from there, figuring out our liability, figuring out the ways that you can potentially save money as you plan things out. Okay, and so It is pretty common practice to go ahead and ask for past year tax returns when we're doing this. I was shocked when I realized, or I learned just how many people pay tax preparers to do even very, very simplified forms to send off to the IRS, paying a few $100s for them to put those few numbers in the 1040 and then sending it off for them, because people don't want to do taxes. I think it's intimidating to them. They don't know much about it. And it is something that means that there are very few, much fewer DIY people out there than maybe you would think in that process. All right, so the very first thing I think that we had talked about was really just understanding and getting to a point where we're able to see exactly where their adjusted gross income is, okay? Because it's going to ultimately tell us just where they are in terms of their tax bracket. Many of the methods and strategies that we use when we're trying to lower tax obligation don't work for people in lower tax brackets, because if you're only in the 10% or 12% federal tax bracket, it's not going to make too much sense for you to go after some type of municipal bond investment because you're already in the lower tax bracket. You would do better to go ahead and find a higher yielding option, not worry so much about taxes. However, people who have, especially like large sales in the course of 1 year, people who have really high income, are paying up into the 30s in their income tax bracket. Well, then at that point, more and more and more of these tools become something that is important to consider. And so, again, we go back to it, like tax planning in the world of a financial planner. The tax planning part of our mind always has to be on, right? And as we go through discussions with clients, the more the more you're able to say, hey, that's kind of a red flag in terms of maybe making a decision that's not tax beneficial for near term or longer term, or making decisions that could potentially help someone, like going above and beyond to look at some different options out there. And so here you'll talk a little bit about the alternative minimum tax, okay, the different triggers of those. Okay, so the alternative minimum tax is just there to make sure that people who have high passive income are still paying a baseline of tax, and so those people, typically people with higher net worths, can't game the system so much so that they're lower their tax rate to effectively be zero. Okay, so there's different scenarios there that kind of play through that example. Okay, incentive stock options, if this AMT didn't exist, you would probably see a lot more options out there for people who make high income, live in the corporate world, going with ISOs, right? But the AMT is a leveling of the playing field. It's supposed to provide at least a baseline of tax for most people, right? Not to say it's not perfect, right? Like Warren Buffett a few years ago talked about how he was paying at a lower tax rate, all things considered, than his secretary working for him because of the stock that he has and things like that. And so is that the goal of taxes, to be as fair as possible, to make those with the wealth, right, pay more and more, like a progressive tax? Or is it, what is the goal? Well, it is what it is. It's a necessity, and oftentimes we say, listen, there's a big difference between tax evasion versus being tax effective. In the text, I think it says, it calls it, avoidance versus evasion. It's okay to do things that are tax effective. No one wants to pay more taxes than they should, and that's okay. As a matter of fact, there are a lot of incentives in this world of our tax law here in the United States that does allow for good deferrals to be made, right? Like it's good the fact that we can maybe if especially if you're giving as high, we can count that to offset some of our taxes, and that's a really neat thing, right? Like kingdom-centered, focused people should be those who are the most desiring to see their money go toward causes, usually like, things that are related around your kingdom community and your church and things like that. So all that being said, okay, I tried to do my best not to get into the whole tax argument, with people about like, oh man, yeah, you're gonna have to pay taxes. As a matter of fact, a lot of times people come in to us and they go, of course, this is a very common thing. They go, how can I pay less in taxes, right? Like, and the truth is, you need to just recognize you're gonna have to pay them, right? Like taxes are one of those things where it's not really gonna be a situation where you can look at someone in the eye and say, oh man, like we can make a lot of tax effective moves for you. You can do little things to feather, down their tax obligation or save into some tax advantage strategies, especially if they have the margin in their life to do so. If they have, some different things going their way, like large taxable accounts, and if they're willing to give, if they're saving for college, if they're saving for their health needs, and they have options to do so, right? But those are all, in some ways, like many ways, they're benefits. And so some people don't have any of that going for them, right? Maybe they're single, they don't have a family, they make a large income. It's NEC, right? Like non-employment compensation. And so at that point, then it becomes like, okay, well, you're gonna have to make your own route for retirement. We can try to do that in a tax efficient way, but that's about it. That's where the buck stops in terms of being tax strategies. Okay, so helping people understand we all have to pay them, right? And just because you're talking to a financial planner doesn't necessarily mean you're gonna walk away with 1,000 different ways to decrease your taxes all the way down to zero. And in the end, this is another example of how we as financial planners, okay, this whole field, we want to bring the community that someone maybe already has connected and what kind of have a relationship with estate planners, relationship with tax planners and CPAs in your community, to be able to refer people to them, but also be able to you're not a tax professional necessarily. And unless you have maybe a CPA designation, or someone in your office that does that. And so in the end, it's just like we're going to give you some good pointers, but we're not going to be able to, actually give you full on heavy tax advice. All right, here on page 4, as we dive into this is just some important ratios when tax planning. The biggest one would be I think, tax equivalent yield, especially at the federal and state level, right? Where you're basically taking what you'd be able to get somewhere else and taking one minus your rate and seeing if that bond yield is going to be higher than that. So a perfect example would be like muni bonds, maybe paying out 3% now, but you can go into a money market at 5%. Well, the money market's going to be taxed at the federal and state level, right? And so is it going to make more sense? Well, you're going to have to use this ratio to figure that out. And that's something that will be asked of you this week. These different tax discussion strategies, I think the flow chart does help you here, right? Is it above the line or below the line deductions? Okay, and then basically just kind of follow that path to see if it makes more sense, or what can you potentially do to decrease your tax obligation. Those fonts are kind of small, but you get the idea, right? And again, we're seeing more and more people. See, it used to be like tax planning flows into retirement planning a lot of different ways, right? So, and vice versa. And so it used to be, right, you have your defined benefit plan, your pension, and you don't really worry too much about anything else, because your employer is going to be basically footing the responsibility. Well, now defined contribution plans have taken over in the world. But we live now even in another kind of newer age, the gig economy and the world of contractor work, where people are not even getting that option, right? So you have to go above and beyond even to be able to contribute to a retirement plan, but there's still some good options. And so this is like, is the client self-employed, right? If yes, then maybe we would look into SEP or simple, maybe a solo 401k option. Okay. Try to find ways to increase that Schedule C expense, because those expenses above the line are going to be able to decrease not only your income tax, but also your self-employment tax, right? Because you're paying on both sides of that. That's 15.1% paying to Medicare, Social Security. And so that's kind of the options here. Of course, purchasing health insurance, you're able to write that off as a self-employed person. So yeah, let's kind of continue moving on. Okay. Lowering your earned income. If you are in a traditional workplace environment, a lot of times you look at the fringe benefits that you're able to be provided at work. Can you go ahead and take your all of these different things out? Okay. Educational assistance, group term life. Okay. Health savings are wonderful tools because they're the triple tax advantage option. um you know, Meals, moving expenses, all tuition reduction, all those different things. And so it kind of gives you a big old list of different benefits that can apply to lower the cost of taxes. Okay. Um, General tax strategies that we see, very common ones. Okay, here we go. Convert taxable interest to tax exempt interest. Okay, again, you have to be in a higher tax bracket to do that, but it is something that is potentially there. And we're finally seeing some advantage in the bond world to clients doing that more than even just a few years ago. It was still a popular thing. We saw some clients coming in with muni bonds even 4 or 5 years ago, but they didn't make much sense. And now it's more common than that. 529 plans are becoming more popular even now. Again, the Secure Act 2.0 allows some of those 529 plan funds to actually be converted to Roth IRA for beneficiaries. So there used to be a lot of concern that people would go ahead and put money into a 529 for their kids and the money would get stuck in the plan. You can still take it out with penalty, right? But like, they didn't like the idea that you can give it to your kids or any of your kids, even if it's in one of your kids' names. You can change the beneficiary on that. But anyway, then maybe, I don't know, give it to a grandkid if it stayed in the plan, you didn't want to pay the penalty. Well, now up to $35,000 per plan can get rolled into a Roth IRA if it's been in the plan for 5 years, et cetera, et cetera. So I think more people are probably using that. But again, it's one of those things where it's like, we want to do our best to provide this holistic planning approach. And so often people don't look at things in that regard, right? Furthermore, like, we've got these different silos that we can invest our money into, okay, to get them to our goal in the future. And so if we don't do that with some people, they're going to let that money just roll into their bank account. If it's in my bank account, I'm going to spend it. And so they need the structure. They need a mental accounting tool, right, to help kind of move money out of my bank account into ways that can help a future goal be reached. And so a lot of those are going to be tax effective, like Roth IRAs are wonderful tools. A lot of times when we meet with a young person who's just starting out, we say, hey, first things first, man, like go ahead and save as much as you can into a Roth IRA. You can get your employer match, but then after that, Roth IRAs are the place to go after you have enough money saved into emergency savings. Okay. But then 529s are wonderful tools for that as well. Okay. And so as we kind of go through things, I think probably some of the big idea takeaways from this would be like, um, we want to understand the difference between um, gross versus net. Okay. Oftentimes when you're talking with people in the financial planning world, they're either going to need to be able to take funds out, pay taxes on them if they're in a retirement account. Okay. And so understanding those different categories, okay, of what's gross versus net is a big deal. Gross would be the entire amount. Okay. Net would be what you get into your, you actually see hitting your bank account after taxes. Okay. So a gross paycheck comes in. And then after all of the different employer stuff that you see coming out, okay, what you net is the final amount of money hitting your bank account. And so just, yeah, keep that in mind. Another one that we've talked about so far today is just avoidance versus evasion. We are not ever promoting tax evasion. Too many stories as well of people who have cut corners in their taxes just to kind of find themselves in a really bad place way down the road. And I think another theme in tax planning is kind of a short term, 1 year time horizon planning versus kind of holistic life planning. And again, that goes back to that example I showed you where sorry, I don't know how to spell holistic. Goes back to that example where we saw that couple saving a ton of money into their 401k earlier in life. And then, I actually haven't even given them the recommendation yet. That was a person I met with this last week. But the recommendation is going to be, we need to balance your financial plan out. You've done a great job of saving into the 401k. That's a great thing, right? Like that's good. But now we need to kind of build up the other aspects of your plan so that you have more arrows in the quiver, right? You've got some tax-free assets, you've got some taxable assets, you've got other things that are going towards your plan that aren't, you don't need to have $20 million in a tax deferred account by the time you reach 75. That's actually going to be a really big challenge. Okay. Some other themes, that we talk a lot about the credit versus deduction theme. Okay. Tax credits are very different than tax deductions. As a matter of fact, what the worksheet, how the 1040 works is like you go through your deductions at the very end, then you are able to add in your tax credits. Okay. Tax credits decrease tax liability dollar for dollar. And so child independent care expense credit is a very big one. Disability education credits, retirement savings contributions, child tax credit, adoption tax credit, all of those things will reduce your tax obligation, how much you owe. Oh, if you owe $10,000, you get a $5,000 credit, right? You're going to see $5,000 reduced in your taxes. Deductions don't work like that. Deductions are going to lower your income, right? So if you have, say $85,000 in income, $5,000 in deduction, now you have an $80,000 income on which you're going to have to pay taxes for, right? So I know that's tax planning 101. Most of you probably already know that, but it bears being stated. And then another thing that we see here, all right, and sex brings us up to progressive versus regressive taxes. Okay. And usually they kind of work in one direction or the other because it's hard to find flat tax things. Okay. A perfect flat tax, I always say, is like gasoline, right? Like you're paying a percentage of what you do at the pump going to tax. It's going to be flat. And it's a great system where it's dependent upon how much you use, right? How much you use the road is going to be related to how much you use in gasoline. And so that's a flat tax. But most taxes are progressive, meaning as you get higher into a category, you're going to be paying more. And then you also have regressive taxes, which work the opposite of that. Okay. The more you pay in tax, potentially or I should say the higher income you have, maybe the more of a deduction you could potentially get, right? So like itemization is an example of a regressive feature in our progressive tax code, okay? Where people who have large houses, people who have large medical bills, people who give a lot of their money away, there is this regressive element to that, right? Which most people are not going to be able to take advantage of. And so one of the big features of that tax 2017 Trump era tax reform was pretty much a doubling of that standard deduction, which means it actually lost a little bit of its regressive feature, right? Because now, or I guess I may say it added some, because now you had to give away a lot more, have more in mortgage, interest than before. Okay, so but also lower taxes, because now everyone is able, I think this next year, just under $30,000 can be applied to the standard deduction for a married couple, which is much bigger than it used to be. Let's keep moving on. Okay, we're gonna get to this other strategies here. All right, this is a big one. Donate appreciated investments to charity. Okay, is a theme that we see, especially in planning. We've seen the rise of donor advised funds. Okay, DAFs. And donor advised funds are basically like your own little charitable a trust. You actually give up control of the assets to the fund itself whenever you give it away. But in the year that you give, maybe it's appreciated stock, you put it into the donor advised fund, you get you can basically use that for itemizing that year. And then it's allowed to continue to grow inside the donor advised fund, and then you can give it away at a date down the road, right? So you don't actually have to technically give it away in the year that you put into the donor advised fund, which allows for this clumping and clustering that you like to do when it comes to giving money away, right? It makes more sense to go ahead and take the standard deduction in maybe year one, and then in year two, itemize, and in that year, donate a highly appreciated stock into your donor advised fund, while also maybe giving a little bit extra, and so most of the time we want smooth, right? We want smooth income. We want to pay a smooth amount of taxes. We want to smooth out things, but when it comes to tax strategies, at least in terms of giving, we tell clients that even if you can do it every third year, we're not talking about only giving away in year three, right? We're just saying, listen, because of the donor advised fund, we can put money into that account on that third year. So then you can give away, from that fund in years 1 and 2, which will allow for us to greater optimize that itemization schedule. Businesses are good for reducing expense. Okay, so they allow us kind of that option on the Schedule C. Of course, with businesses come the self-employment tax as well, which can work a little bit more complicating. And then there's other different strategies you can use. 1035 exchanges are very popular. When you're trying to switch in and out of insurance policies, or for real estate movement. Basically, you don't have to take the appreciation and pay the capital gains on the growth in, say, a rental property, right? Because then you can take that growth and apply it to a new place. You just have to purchase, a new rental home or whatever it is within the scope of that time period. And so that's a very, very common strategy that we see being used. Okay. HSAs are wonderful, health savings accounts. These numbers again go up just a little bit every year. And that's really kind of the challenge in tax planning, right? Is that we get a little bit of adjustments and changes in those numbers every year. So you have to kind of keep abreast of all of that. And so the learning objectives here at the bottom, I was going to spend just a little bit of time talking more about do's and don'ts in terms of tax planning as you prepare for the DOS case and some others. And so here's my worst tax advice. Okay. I'll be a little bit of, what do you call it? I'll work in some funny ways here, try to think about the opposite of what you do. Here's one I've seen. Uh, when I've done some financial counseling for lower income people, okay, they like to get their tax refunds from H&R Block or some other tax planning preparing companies before Christmas, right? Typically you do your taxes, whatever the beginning of the year, January, February, March, you get your refund a little bit shortly after that. But these companies figured out that people want their tax refund before Christmas so they can have a good time at Christmas. And so an example of that, one time I saw someone was going to get $2,000 back. Well, instead they did this little program here and got, I think it was $1,600, $1,620 back, right? And then of course H&R Block or whoever it was able to get the full $2,000 by waiting just, oh man, they probably filed in January. So in 1 month, that company made $380, right, on a very short-term guaranteed loan of I guess it would be $1,600. So they made, close to 25% on this person, in just a matter of that, just because they wanted their refund before Christmas. They thought it was a great deal, and I had to kind of explain in the world of finance, it's a pretty rotten. It's a payday loan in many ways, right? A tax time type of loan. So didn't know if you guys knew those things existed, but that's bad advice. Don't do that. Put those muni bonds in your retirement account. We've seen this from clients before, and it's a big red flag, right? Muni bonds are there because they're going to be discounted because of their tax efficiency. And so if you have muni bonds in a retirement account, you're not getting any of the benefit at all from having that allocation. And so that is a big red flag, a big no-no. Don't save into the Roth is another one. Okay. We love Roth accounts because of their potential to provide that tax-free interest and growth. And so sometimes a lot of times we see people, especially people born in the 50s and 60s, they didn't have Roths most of their career. And so they never really saw that as a need. And so we have to help them unwind that with Roth conversions and pay some taxes in their 60s to help them have a little bit more money on that side of things. It also takes out the tax rate risk down the road. And so we a big mistake is not saving into the Roth. If you save into your Roth, access these contributions early, like in a few years or afterwards. After 5 years, you have access to your Roth contributions even before you're 59 and a half. So you can access those things. But really the point of the Roth IRA, right, is that it is one of the best options out there to really see some incredible growth, all of it tax free. And so if you're accessing those contributions, even if you're not paying a penalty, it still hurts retirement planning. And oftentimes we see people doing that because, hey, it's not penalized, but usually behind those stories are sad ones, where it's like people are finding themselves in a spending crisis, or they're not in a good place with their finances. And so usually for us, that's a red flag. When we see someone with that phone call, we want to sit down with them and see how things are doing. Probably help them work through some issues maybe they're having. And then tax defer to the max. It can work. It sometimes is the most effective options, but sometimes it's not, because to tax defer everything would mean down the road you will be paying more in taxes. All righty. So that's the tax lesson for today. Again, I'm posting this kind of really before we dive into week 2, because I'll be on the road. And so anticipate seeing another video come out at the end of week 2, probably Friday or Saturday, talking more about the module 1 material that we are working on currently while I'm making this video. Yeah, I know you guys have all been in the rhythm of going through the CKA biblical worldview curriculum. I really like those. I've actually watched many of those videos already through our Kingdom Advisors group. There was one from Ron Blue on leadership where it talks about we are called to be an advisor, a counselor, and leader, right? Advisors give technical advice, counselors kind of are there to build up relationships, break down the barriers between people or the relationship maybe they have with money. And then leaders are there to inspire and influence and help people grow as people, right? And so I really enjoyed watching that video, maybe a year back, and took a lot of notes on that one. And so anyway, it's neat to be able to see you guys working through that curriculum early on, because it's such a formative time, right? When you're developing not just the knowledge that you need in this field, but also developing the whole sense and understanding of how it flows into who we are or who you're called to be as Christians, what it's like to be a leader in this field where you're going to have money conversations that come up quite frequently on this topic. So again, as you work through things, do not hesitate to reach out to me. I've received quite a few text messages from students who have had things pop up, and I like that because I know I'm going to be the most responsive that way. I'd even be okay with a phone call if you texted me and say, hey, can we talk about, this or that? Maybe that would be easier than 15 back and forth text messages. And then email, sometimes lengthier questions as well. On my Gmail account, which I've got in our syllabus, benstro@gmail.com, it's probably going to be the best option to reach out to me with. Hope you guys are doing well. I hope you had a good July 4th. My kids had their sprinklers out and the smoke bombs and stuff, so we had a good time. No one blew anything up that they shouldn't have. So I hope you guys are doing good, and it's nice to discuss this topic with you. Have a good one.